Well, let's get some perspective now from Phil Orlando, Chief Equity Strategist at Federated. Phil, good as always to see you. Question number one, is this bull market interrupted or bull market fatally wounded?
We're just interrupted, Tyler. I mean, there's no question that the sell-off was a reaction to the Fed announcement, but I think the market's missing it. The Federal Reserve, in our view, is going to be making a data-dependent decision. For them to be pulling the accommodation, which has been extraordinarily aggressive now for a number of years, they have to believe that the economy is ready to grow on its own at or above trend line, 3% or better. And they wouldn't be pulling the accommodation if they felt that the economy was still weak. So that's a positive, not a negative.
Basically, it seems to me, Phil, that what Chairman Bernanke said yesterday was basically what he's been saying for months. Now, he did put some more sharp points on it, but what occurs to me is that the sentiment in the market has changed. A month ago, when there was bad news, the market played past it. Today, when there are signs of good news in the economy, the market doesn't take it very well. Why did sentiment change so abruptly?
Well, you know, the market since the middle of May, I guess it was about May 22nd when this news first started to break, the market's been down about 6% over that period of time. So there has been sort of a shift to negative sentiment. And generally around FOMC meetings, you do get this volatility. In our view, this move today was oversold. That's not to say that we're absolutely at the bottom. From a technical perspective, theoretically, you could lose another couple of percent, but we think this is setting up as much more of a longer-term buying opportunity than a chance to be running for the hills here.
So if you agree with your point that this is a buying opportunity, if you think that the economy is actually starting to get into a higher gear, which is certainly what Chairman Bernanke was suggesting there, where are the best opportunities to buy right now?
What you want to be doing is focusing upon what Bernanke said. If the economy is improving, what are the economically sensitive sectors of the market that are cheap and poised to do better? We would focus on two areas. Financials, like banks or insurance companies or diversified companies, and consumer discretionary stocks like housing, autos, and media. These are areas that are levers to the economy, and if we're right that the economy starts to pick up in the second half of this year and into next, then those stocks are pretty cheap and they ought to do pretty well.
How alarmed were you by that Chinese manufacturing number that came out overnight? It certainly kneecapped the commodities space and presumably some of the commodities stocks as well. Is this what you would see as the beginning of a long-term slowing in emerging markets and in China?
Yeah, there's the $64,000 question. I mean, we've been in the midst of an emerging market slowdown now over the last several quarters. And the PMI number that we saw out of China overnight was just another incremental data point that continues to concern investors. We would like to see the Chinese government come out with some fiscal and monetary policy initiatives that will sort of re-stimulate growth into the back end of this year or the start of next. But at this point, it's like waiting for Godot. We're watching the economy slow down in China. We're at maybe a 7.5% to 8% GDP run rate this year. We'd like to see that number sort of stabilize there, maybe move a little bit higher. But right now, the market's concern is that we're looking at an emerging market hard landing. And while we don't think that's going to happen, it's very difficult to change that sentiment in the face of data points like we saw this morning.
Phil Orlando of Federated, always great to see you.
Thanks, Tyler.